Buying a home is exciting, but the mortgage process can be confusing, especially when it comes to interest rates. Fear not, this video is your guide to understanding mortgage interest rates, how they work, and what factors affect them. Whether you're a first-time homebuyer or a seasoned homeowner, this video will equip you with the knowledge you need to make informed financial decisions. Hi, my name is Nicole. Welcome to my channel, Travel to Money. In this video, I will answer the question, what are mortgage interest rates? Then we'll go over factors affecting mortgage interest rates. We'll briefly cover different types of mortgage rates, shopping for a mortgage, and then I'll share some real-life examples and show you how to use an amortization calculator. Don't worry, amortization is just a big word to describe the paying down of a mortgage. It doesn't bite. Before we jump in, just a quick disclaimer that I am not a financial advisor, and before you make any decisions with your money, you should always consult a professional and do your own research. Okay, so let's get started by answering the question, what are mortgage interest rates? When you get a mortgage to buy a house, you borrow a large sum of money from a bank. You pay back the loan amount over time, but you also pay the bank extra as a fee for lending you the money. This extra fee is the mortgage interest. The interest rate is like a percentage of the total loan amount. So a lower interest rate means you pay a smaller thank you to the bank, and a higher interest rate means you pay a bigger thank you. Although mortgage interest rates might seem low, especially if you're comparing to something like credit card interest rates, the impact can still be massive because typically mortgages are taken out over a long period of time, and they are also usually for much more money than what you would have on a credit card. Okay, now we're going to talk about factors that affect mortgage interest rates. First, we'll cover market factors, and then we'll cover personal factors. Imagine you're buying groceries. When there are plenty of apples on the shelves, the store doesn't need to charge a lot to sell them. But if there's suddenly a shortage of apples, the store might raise the price to make sure everyone gets some and they don't run out too quickly. The Federal Reserve, also known as the Fed, is like the store manager for the entire economy. They try to keep things balanced, including inflation, which is the rate at which prices of goods and services generally go up over time. When inflation is too high, it's like there's a shortage of apples in the economy. Everything starts costing more and people's money doesn't stretch as far. This can be bad for everyone, including homeowners. That's where the Fed comes in. They have tools to control inflation, like raising interest rates. Think of it like the store raising the price of apples to control how many people buy them. When the Fed raises interest rates, it becomes more expensive for people and businesses to borrow money. This includes things like mortgages, car loans, and business loans. By making borrowing more expensive, the Fed discourages people from spending as much, which can help slow down inflation. However, there's a trade-off. While lower inflation is generally good, higher interest rates can make it more expensive to buy a house or other big-ticket items. So the overall health of the economy and inflation play a significant role in determining mortgage interest rates. A strong economy and low inflation generally lead to lower interest rates, while a struggling economy and high inflation can lead to higher interest rates. Okay, now that we understand some of the market factors, let's move on to personal factors. The first we'll talk about is your credit score. This is like a report card for your borrowing habits. A higher credit score shows you are a reliable borrower and likely to repay your loan on time. This translates to a lower interest rate as lenders see you as less risky. Conversely, a lower credit score indicates higher risk, and lenders might charge a higher interest rate to offset the risk of you potentially defaulting on the loan. The next personal factor is your loan amount. Think of it like borrowing a small sum from your friend versus a large amount. For a larger loan, your friend might be more cautious and charge a slightly higher interest rate to account for the bigger risk involved. Similarly, lenders might offer slightly higher interest rates for larger loan amounts as it represents a bigger financial commitment for them. The last personal factor we'll cover is your loan type. You typically have either a fixed rate mortgage, meaning the interest rate stays the same throughout the loan term, offering stability but potentially higher rates. The other type is an adjustable rate mortgage, or an ARM. For this kind of loan, the interest rate can adjust periodically, potentially starting lower than fixed rates, but carrying the risk of increasing in the future. For the record, I am not a fan of adjustable rate mortgages. I've seen people going from having an affordable mortgage to having their mortgage nearly double because they were in this type of loan. Sometimes it might look shiny in the moment, but I'm all for the stability of a fixed rate mortgage. Anyhow, now that we understand the market factors and personal factors that go into determining a mortgage interest rate, let's talk about shopping for a mortgage. Finding the right mortgage is like finding the perfect pair of shoes for your new home. It needs to fit your needs and budget comfortably. The first thing you'll need to do once you're pretty serious in the process is getting pre-approved. Imagine trying on shoes without knowing your size. Getting pre-approved is like knowing your mortgage shoe size. It tells lenders you're serious and shows them your borrower power, potentially leading to better rates. The next step is to compare rates. Don't settle for just the first offer. Shop around with different lenders, including banks, credit unions, and online lenders. Compare their interest rates, fees, and loan terms to find the best fit for you. From there, you'll want to consider different loan options. Just like different shoe styles offer various features, explore different loan options like fixed rate or adjustable rate mortgages. Each has its pros and cons, so choose the one that aligns with your financial goals and risk tolerance. You may also be able to explore other specialty loan products like FHA loans or VA loans. Now that you know what you've been offered, don't be afraid to negotiate. Just like you might haggle for a better price on a car, you can negotiate your interest rate and fees with lenders. Be prepared with research and compare offers to get the best deal. From there, be sure to look beyond just the interest rate. While the interest rate is crucial, consider other factors like closing costs, origination fees, and customer service. Choose a lender that offers a competitive package and prioritizes your needs. I've worked with good lenders and bad lenders, and let me tell you from personal experience, they are not all the same, and a bad lender can be a real headache. Now, here are some tips to snag the best rate. Number one is probably obvious, but be sure to maintain a good credit score. Another thing to consider would be to make a larger down payment. Putting more money down reduces the loan amount, making you a less risky borrower. You can ask your lender if this could get you a lower rate. Next, you can look at a shorter loan term. Shorter loan terms often come with lower interest rates, and they don't raise your monthly payment as much as you might think. I'll show you some examples in a minute. Another thing you could consider, but really depends on your situation, is the ability to offer additional collateral. If you have valuable assets, using them as collateral can improve your loan terms. Remember, shopping for a mortgage requires research and patience. By following these steps and staying informed, you can find the perfect mortgage shoe to comfortably step into your dream home. Okay, now that we've covered all of the basics, I want to show you how to use an amortization calculator to better understand your options and how you can pay off your loan faster than you even imagined. I've actually added an amortization calculator to my website where you can follow along or use it to run your own numbers. Visit traveltomoney.com/amortization to use it now or find it in the description. So on this particular calculator, we are only going to be looking specifically at your loan payments toward principal and interest. This does not include things like insurance, taxes, HOA fees, and other variables. If you want me to make a page with a mortgage calculator to calculate all of those fees as well, let me know in the comments. For now, let's look at this amortization calculator. The reason I'm so interested in this right now is that I'm in the middle of a home purchase in Florida. So I've been talking with my lender daily, looking at rates, comparing the loan terms, and then using an amortization calculator to see what is truly best for my situation. Okay, so let's keep all of the numbers super easy. Let's look at a loan for $120,000 with a traditional down payment of $20,000. That means the loan itself will be for $100,000. Let's do an interest rate of 7% and a loan term of 30 years. I'll just leave the date here set to January 2024 so that we can easily follow the dates. In this case, we are going to start by looking at the details if you only made the basic payment every month for the entire loan term of 30 years. You'll see here when we run the calculations that the total interest paid by the end of your loan is $139,508.90. But you only borrowed $100,000. That means on a $100,000 loan, you paid back $239,508.90, more than twice the amount of money you borrowed. The monthly payment on this loan, not including things like taxes and insurance, is $665.30. Okay, before we look at adding extra payments, I want to take a look at a 15-year term instead of 30 years. Look at the difference in these numbers. Your monthly payment only goes up by $233.53, but you pay off the loan 15 years earlier and only end up paying $61,789 in interest. That's less than half the interest, and the total you pay on the loan drops all the way down to just over $161,000. Isn't that insane? Now, let me show you another trick. Let's go back to the 30-year loan. Remember how the payment on the 15-year loan was $233.53 more? Well, we're going to take that same amount and add it onto your 30-year loan as an extra monthly payment toward your principal. Guess what? You still pay off the loan in 15 years, and you still keep the interest that you pay in the range of $61,000. The nice thing about this is that you get all the benefits of a 15-year loan, but you have the lower monthly payment just in case you run into a hard time financially. But I want to note something here. A lot of people don't have the financial discipline to make a payment more than just the minimum monthly payment. So you really have to pretend like the higher payment is your normal monthly payment. Okay, let's look at some other math magic. Let's go back to the 30-year loan, and let's just say you are going to put an extra $1,000 per month toward your principal. This is crazy. You end up paying off the loan in 6 years and 3 months. Not only that, but now you've also reduced your interest to under $24,000. Now, I know $1,000 per month is a lot of extra to put on top of a monthly payment, but in this case, if you could hustle and do that for 6 years, you get to live without a mortgage for the rest of your life, or however long you own that home. As you can imagine, using a calculator like this can help you to play with different numbers and see just how fast you can pay off a mortgage. I really hope that this has helped you to better understand mortgage interest rates and has encouraged you to go do the math for yourself with the help of an amortization calculator to see how we can get you out from under the debt of a mortgage faster. Let me know where you're at with your current mortgage or how you're planning for a future mortgage in the comments. I'd love to chat with you there. Do me a big favor, like this video and subscribe to join me every day where travel and adventure build financial freedom. I can't wait to see where your dreams will take you.